Hi everyone, thanks for the time given to us. We are from Group 1 and I would like to introduce my group. My name is Putri and my partners are Erlin, Adhi, Cynthia and Natalia. Today we will discuss about derivatives to you. First, I will explain to you about definition of derivatives. The term derivative is closely related to the world of finance, can be interpreted as a financial contract between two parties or more aimed at fulfilling an agreement on the sale or purchase of certain assets or commodities. This financial contract between two or more parties can be used as an object that can be traded at a price that has previously been approved by the seller and buyer. In the future, the value of the contract price will be influenced by the price of the asset or commodity. Next, definition of derivative transaction. Currently, this derivative transaction consists of a number of principal points. First, interest rate. Second, currency. Third, commodity. Fourth, equity, and the last, other indexes. The majority of these derivative transactions are over-the-counter OTC products, contracts that can be negotiated privately and are also offered directly to end users, as opposed to contracts that have been standardized and are also traded on the exchange. Next, how derivatives work. As explained earlier, that derivatives are one of the derivative products of all investment instruments on the market. This becomes its own uniqueness for derivatives because it can be used as an investment alternative. For example, about the purchase of gold. Simply, derivatives are investment based on trading contracts. Derivatives can also be categorized as high-risk investment because they tend to take advantage of future price speculation, but with a large potential yield. To make it easier to understand, for example, when you invest in gold, then you will buy gold at a certain price and sell it at a higher price. But in the case of derivative investment, then you can trade this contract without having to hold the gold first. The contract price is volatile and depends heavily on the price of gold commodity in the market. The next material is read by Erlin.
Derivative benefits. First, minimizing the level of financial risk. Derivative instruments are able to minimize the occurrence of loss and financial risk. Why is that? This is because derivatives are investment instruments in the form of trading contracts in which they contain a number of agreements that serve to describe rules and limits in the implementation of activities when investing, so that later they can get large profit. Second, protecting commodity value. Derivative instruments are able to protect the price and value of a commodity because it is caused by a series of process assessments of derivative products are complex and detailed. Therefore, when investing in derivative instruments can keep the value of commodity stable and not decrease in value. Major types of derivative. 1. Futures contract. Future contract is a contract commonly traded on the future exchange to buy or sell an asset or instrument at the future date at predetermined price. 2. Option contracts. An option product is an instrument that will give the holder a right to buy or sell an asset at a certain price or before the expiration date. 3. Swap. Swap are agreements between two counterparties to exchange a series of cash payments for a stated period of time. Example of derivative case in Indonesia. The derivative case of PT Indosat Tbk. In the 2006 financial statements, PT Indosat report a loss of 438 billion rupiah, claimed as loss from change in fair value on derivative transaction net. Recognition of this loss arises because the company did not implement PSAK as it should. In PSAK number 55, Accounting of Derivative Instrument and Hedging Activities, it mentioned that derivative transactions require formal documentation of risk management analysis and transaction effectiveness analysis if you want to protect the risks and derivative transaction. In addition, an entity is required to report its derivative transaction at least every 3 months in the company financial statement.
The next, derivatives. Example of derivatives comes in Indonesia. Solution. The derivative case of PT Indosat Tbk. In a letter addressed to Indosat Management or Management Letter in 2004, 2005, and 2006, Indosat external auditors requires Indosat Management to immediately correct the formal risk management policy related to derivative transaction. According by Indosat, amounting to use to 75 million or approximately 2.5 trillion. There's derivative transaction including in contract agreements with follows financial institution. This gross profit an example for the magnitudes of loans that must be bound by company in Indosat due to the absence for adequate analysis for derivative transactions to be carried out. As a result of the loans, decided also loans potential tax back on the company's net income and on individuals distributed.
Yes, good. The next material is derivatives. Derivatives, leading answer. Do you know what the main types of derivatives are? Yes, the main derivatives are futures, options, and swaps. What are the two main use of derivatives? That is, derivatives can be used and twice either to mandates, risks handling or assume risks with the expectation of equal returns speculation. Does the organization you worked for use of trade derivatives? No, because we are not in any organization.
Well, I will conclude explain above. As explained above, a derivative is a bilateral contract or payment exchange agreement whose value is derived from a product that becomes a principal reference or also called an underlying products. Instead of physical trading or exchanging an asset, market participants make an agreement to exchange money. Assets are a value in the future with reference to the underlying asset. Derivatives are used by investment management or portfolio management companies and financial institutions and individual investors to manage the position they have against the risks of stock and commodity price movements, interest rates, foreign exchange rates without affecting the physical position of the products to which they are referenced. In the future, it is expected that there will be warm inputs for the finance industry, especially product development, because basically Indonesia is a good investment country for the world generally and the Middle East in particular, just waiting for superior products and instruments used by Indonesia along with supporting laws. If we don't respond to this hook market desire, it's fair we can take on this hook market potential. Thank you.
Before we close, we say sorry if have a wrong word in our presentation. Thank you for attention.